Next topic is cash operating cycle. Again, a very important concept. So cash operating cycle is actually, cash to cash cycle. What does that mean? So if you are in a business, let's suppose that you manufacture something, maybe you are manufacturing furniture. So you've got cash in your bank. So what do? You, from this cash, you purchase the raw materials. So cash is converted to the raw materials. These raw materials will stay in your raw material warehouse for, let's suppose, 7 days. Then these raw materials are issued to the production floor and you manufacture or you make some furniture. So 2, 3, 4 days of production process will go on. So the raw materials will be converted to the finished goods. Then this finished furniture will go to your finished goods warehouse and it will remain there for another 10 days or maybe 15 days. And then this furniture is sold to your customers and the customer promised that they will pay you in 30 days. So after 30 days, you will receive your cash. So what happened? That you took money out of your bank, you purchase raw material, then raw material went to the production, then production go to the finished good warehouse, then it was converted to receivable, and then the customer pays you. So from day one to the day end, probably this is a process of 50 days. So it takes like 50 days to complete one cycle. So what you need to do, you need to add up all these stages, like number of days in the raw material warehouse, plus the number of days in the production process, plus the number of days in the finished goods warehouse, plus the number of days of receivables. You have to add all of them. It makes it 50 days. But then you have to subtract one thing. And that one thing is that possibly you are purchasing the raw material on credit from supplier. Maybe you did not give cash to your supplier. You purchased some goods or some raw materials from suppliers on credit, and you had 20 days supplier credit terms. Okay. So then when I add up all those, it made 50. And then 50 minus the supplier days, payable days, which I call. So 50 minus 20, 30 days will be your cash operating cycle. This is the general concept of cash operating cycle. Different businesses have different cash operating cycles. Some businesses, they purchase goods in the morning and they sell in the evening. For example, a person who sells fish, every morning they go and purchase fish. By the evening, they sell everything out. They don't keep fish overnight. If you go to a supermarket, some products are sold very fast, some products are sold very slow. Similarly, if you go to a manufacturing business or a construction business will have a very long cash operating cycle, because when you start a construction project, it takes probably 6 months to complete, maybe 8 months to complete. So the production period is very long. So you have a longer cash operating cycle in construction business. In manufacturing, some businesses, they purchase raw materials from the local market and they call to a supplier, they transfer the money, and next day they receive their raw materials. So that's pretty fast. But imagine if you are importing your raw materials from some other country and the supplier says that you transfer the payment and then they will ship the goods and the goods are received in 30 days, because they will go to the port, then there will be shipping time, and then it comes through the vessel by sea, then it goes to customs and clearance, and the time period between paying to your supplier or receiving the goods probably is 30 days. So such a business will have a longer cash operating cycle. So different industries will have different cash operating cycles. We understood. Now, what do we want to do with that? Idea is that we need to keep our, whichever industry we are, we need to make sure that we keep our cash operating cycle at the shortest possible time. Because longer the cash operating cycle is, the more burden it becomes, because you have to finance the business. You have to invest the money, more money into that business for a longer period of time. So if I am in a construction business and I know that in construction, the cash operating cycle is say 180 days as industry standard, I should try to be doing it 180 days or slightly less. I should not be doing it more. Okay. So, but if I'm in a retail business, my cash operating cycle is 20 days because most retail markets, their cash operating cycle is, let's suppose, 20 days. So then I should also be working at 20 days or lower. So if you see that in your financial management, when you do your analysis, if your cash operating cycle is increasing, it is not a good sign, because increase in cash operating cycle means that you have to put more money into the business, into the working capital, and putting more money means that you have to invest more capital into the working capital, and money has a cost. You have to pay more finance cost. So a longer cash operating cycle means more finance costs, and of course it's an expense and we want to reduce it. This is the concept of cash operating cycle. If we see it, cash operating cycle is the period between the point at which cash begins to be spent on purchasing a product and the collecting of cash from a customer. So the time difference between these two events. Cash operating cycle in a manufacturing business is equals to the average time raw material remain in the inventory, less the period of credit taken from supplier. I usually less it in the end. So you should think like add inventory days. We call it inventory days. How many days the goods remain in your inventory, plus production days, plus the finished good warehouse, and then plus the receivables, and then you say minus this period. So I can see it like this. Let me say, I mean, if I see it, I see, okay, this raw material days, I will add up, plus production days, I add up, plus finished good warehouse, I add up, plus receivable, I add up, and this I subtract in the evening, in the end. You can subtract it in the beginning, it's your choice, but I usually add, and only one time subtract in the end. This is the formula, this is how you will calculate. So raw material purchased, raw material used to manufacturing, supplier of raw materials are paid, finished goods stored in inventory, finished goods are sold, customers are paid. So one complete cycle it makes, okay? A manufacturing company buys raw materials and stores them for 15 days in inventory. Products then take 2 days to make, and finished goods remain stored for 20 days on average before sale. Customers, they pay after 50 days, and suppliers are paid after 35 days. So how much is the cash operating cycle? Now, how much it's the cash operating cycle? So 15 days is raw material inventory. I would say that my raw material inventory is 15 days. So I will plus this one. Products take 2 days. I will add these 2 days. Finished goods remain in store for 20 days. I will add these 2 days. Customers, they pay in 50 days, add these 50 days. And suppliers are paid in 35 days. So you have to subtract this number. So the cash operating cycle would be 15 plus 2 plus 20 plus 50 minus 35. Whatever is the answer, that should be the answer for here. Okay. So in many situations, in probably in exam question, they will give you these days exactly, that these are the inventories days, these are the production days, these are the receivable days. You add, and subtract. That's pretty simple. But sometimes they will not give you these days. They will not tell you 15 days. They will tell you this is receivable, this is payable, this is inventory, and so on. And then you have to calculate these days yourself. This, which will be a challenging task, which we are going to do in the next session using the ratio analysis. So sometimes we have to use the ratio analysis to calculate these days, because not every time you will be given this much so easily. Okay, let's add 15 plus 2 plus 10 plus 20 and minus 20. No, sometimes these days are not given. Then you are given a balance sheet. You are given a balance sheet in which you are given these are the receivables, these are the payables, these are the inventories, and you have to calculate it yourself. That could be a little bit challenging. We will do it in the next session. So what is the length of cash operating cycle? 37 days, 50 days, I don't know. Just add it, 15 plus 2 plus 20. Okay, let me do it with you. So it is 15 plus 2 plus 20 plus 50 and minus 35. So it is 52 days. Answer choice should be C, 52 days. Okay, they have done it actually. They have given you the answer, 52 days. You have to add them up and then subtract 35. The longer the cycle, the more funding must be dedicated to funding working capital. Yes, because you have, if you pay attention to the previous question here, these are the days which you need. So you need 15 days in, you need 15 days for raw material warehouse, 2 days for production, 20 days for finished good warehouse, and 50 days for customers. And by the way, this is 50 here. So you make a total, it is 50 plus 20, 70, and 70 and 17, 87 days is the total period. And now I know that I have to fund my business for 87 days. But then, of course, 87 days funding is a long funding. Then I go to a supplier and I say, how much credit do you give me? And the supplier says that I'm going to give you 35 days credit. So that is a relief. So I say, okay, 87 minus 35, that is equal to 52. So this 35 days, which is a supplier credit, that is a relief. Because if supplier says, no, I'm not giving you any credit, you have to pay cash. So in this case, you have to fund your business for 87 days. 87 days you have to fund. And if the amount is $1 million, and if it is a 6% bank interest rate, you have to pay six, because ultimately somehow this business must be financed. Somehow you must purchase the raw materials and so on. So you are going to take some money from the bank, maybe overdraft or some other credit, on which you pay interest. So you have to pay 6% on 1 million for 3%, for 3 months, which is a cost. And you want to reduce your cost. And therefore you went to the supplier and say, give me 30 days credit, give me 40 days credit. Or probably you have to negotiate with your customers. Why do you pay me in 50 days? Please pay me in 30 days. So this is like I know that this is the cash operating cycle, and my objective is to decrease or reduce the cash operating cycle, because if I reduce the cash operating cycle, I will reduce my cost of doing business. I will decrease my expenses, because it is a cost, okay? Because you have to pay interest otherwise. So the longer the cycle, the more funding must be dedicated to funding working capital. Cash is tied up in inventory, then the company has to wait until the goods are sold. This burden is lessened because cash is not needed immediately to pay to suppliers. This is what I said, that if we get this supplier credit of 30 days, that is a relief. So this burden is decreased. Estimate the cash operating cycle length of a supermarket. Now, supermarket has a very interesting model, by the way, and it is actually exactly opposite to the most business models. Because in most businesses, you sell goods on credit. I mean, customers, they come in and you sell goods, and then after 15 days, they pay money, 30 days credit, 20 days credit. So normally customers, you always have to invest money to feed your customers, because all customers you are giving credit. Imagine I distribute Coca-Cola. I've got 5,000 spots in the city, and my trucks, they go and fill in the Coke cans and bottles in 5,000 different stores. And everybody says that they will pay me after 30 days. So if I make an agreement with another store, I have to fill in their refrigerator with $2,000 of Coca-Cola, and they are going to pay me probably in 30 days. So as a Coca-Cola distributor, it is difficult for me. But if I'm a retail store, like I said, that retail stores are different. A supermarket is a different model, because what happens that in supermarket, there are no receivables, because they sell goods on cash. So customers, they come in a supermarket. When do you go and buy goods on credit from supermarket? Never. Either you pay cash or you charge your card, but you pay on the spot. So they don't have credit sales. So they're always receiving cash from customers. But receivable collection period is 0. However, inventory, fresh food is sold in few days, but most of the goods they are purchasing on credit. And that's why I say that supermarket model is exactly opposite to most businesses. They are always in surplus cash. They are never short of cash. They are surplus cash. Why? Because they buy goods on credit and they sell on cash. So if I'm a supermarket, Coca-Cola comes in, I say, put the bottles in my refrigerator. I will give you money in 30 days, but I will sell them tomorrow. I will purchase all other things from different suppliers on credit. Somebody I'm paying in 15 days, somebody I'm paying in 7 days, somebody I'm paying in 30 days. But from my customers, I receive the same day. So I will always have more cash. Supermarkets they are surplus of cash. They have positive cash always. Okay. So the receivable collection period is 0. Inventory, fresh food is sold in few days. Perhaps average inventory is 5 days. Suppliers paid about 40 days, perhaps. So the cash operating cycle is therefore negative 35 days. 35 days negative because I receive cash in 5 days. So my receivable days are 5. My receivable days are 5. This is 0. And supplier days, which you remember, you have to subtract the supplier days, is 40. So I've got a negative 35. Negative 35, negative is not bad thing here. Negative 35 is just an interpretation that cash remains with me for 35 days because from customer, I get money in 5 days. I sell everything in 5 days. I got my cash in my pocket. But to supplier, I have to pay in 40 days. So this cash remains with the supermarket for 35 days, which is actually right, exactly opposite or different from other businesses. Other businesses have to invest themselves. In supermarket, they get money, cash out of the business. So then you have cash operating cycle using financial ratios. This is the topic I was discussing with you. We are going to discuss it now because like in this examples, you were given a number of days, 15 days, 20 days, 35 days. What if they don't give you the days? And then you still have to calculate cash operating cycle. That is the topic we are going to learn from. Using cash operating cycle using financial ratios when the inventory days, production days, etc., are not given to us.